so far so good for the banks. They're saying things are looking pretty good. We're not done yet with this cycle. What are you seeing?
Well, we're seeing a combination of monetary policy and fiscal policy that is supportive of pretty good, growth. Is it lights out growth? No, but we're, at or near full employment, so we'd be concerned if we were growing too quickly. But you've got very supportive monetary policy in the U.S., in the ECB, in Japan, and you have a very, I think, aggressive fiscal policy here in the U.S. with $1 trillion deficit at 3.5% unemployment. Those two things, very hard for the economy to lag when those things are happening.
Ralph, even with that said, we had blowout numbers from the banks this morning, but deal fees at almost every bank have been dipping. What does that mean to you, and what does that mean for the rest of the year?
Well, I think if you look at the volume of announced transactions last year, dollar volume, it was down mid-single digits globally. It was a little better in the U.S., a little worse in Europe and Asia. If you look at the number of transactions, which is what drives advisory revenues more than the dollar volume, that was down sort of mid-double, like 12, 15%, something like that. So last year was a good year, but not a great year. And, so far this year, I think most of the firms are entering this year. We certainly are, with strong backlogs. And, there's reason to be cautious, but cautiously optimistic.